Under the 1961 Income Tax Act, charitable trusts have navigated a process defined by multi-step registration forms, approvals through various local jurisdictional offices, and a requirement to maintain physical records for a full decade. The Income Tax Rules 2026 reorganizes these requirements into a digital framework, consolidating several application stages and reducing the time spent on data storage. For organizations currently registered under the 1961 Act, those existing approvals remain valid. This transition does not require a reapplication for established trusts, and any ongoing assessments for previous years will continue under the old rules. For new registrations, the 2026 update moves the process away from local office reviews, routing all applications through a centralized digital system instead. The process begins at the National E-Filing Portal, now the primary hub for trust administration. The previous system required Provisional Form 10A, followed by regular Form 10AB. The 2026 framework collapses these into a single common form. This single filing simultaneously registers the trust and approves tax-deductible donations. Submitted applications bypass local offices, routing directly to the CPC. Moving applications to the CPC ensures every trust is evaluated against the same criteria, regardless of its location, while reducing the time it takes to receive a decision. By removing local jurisdictional control, the registration becomes a standardized process, moving through a digital queue rather than a regional office. In some cases, an organization may secure a provisional registration, but never actually begin its planned charitable activities. To address these dormant registrations, the portal now includes a voluntary surrender option, which is visible here on the dashboard alongside a specific warning banner. Use of this feature is strictly limited to trusts that have claimed no tax benefits and formally agree not to claim them for that period in the future. Legally, this surrender redacts the registration from the very beginning. As shown on this timeline, the status is treated as non-est, meaning it is viewed as if it were never granted. This provides a way for organizations to clear unused registrations from the system, preventing them from triggering automated compliance flags or audits. Beyond initial registration, the 2026 rules simplify how organizations manage internal goals and compliance data. If a trust decides to change how it uses its accumulated income, it no longer needs to submit an ad hoc application. There is now a dedicated Change of Purpose form, accessible directly through the portal's drop-down menu. There is also a significant change to the day-to-day administrative burden regarding physical and digital record-keeping. While the previous rules required trusts to keep records for 10 years, the new requirement is only 6 years from the end of the relevant tax year. This 40% reduction in mandated storage allows charities to scale back their archiving operations and focus those resources on their actual fieldwork. To align with the 2026 framework, begin by utilizing the single common form for new filings, reviewing your portal for dormant registrations to surrender, and adjusting your internal retention policies to the new 6-year window. The first practical step is to update your organizational handbook and ensure your accounting team is briefed on these new storage timelines. These rules move the government's role into the background, providing a digital toolkit so nonprofits can prioritize real-world impact over administrative paperwork.